Welcome to the Courtroom, your weekly guide into the courtrooms of the country, in a show that tells you how the law of the land impacts your business, your sector and your company. On the show this week, has the draft report managed to steer Indian transfer pricing to safe harbour? Experts fear it may fail to find many takers as double taxation looms large. India will have to convey consistency in its policy as the shine is going off the India story, says Sanjeev Tuna of Allen & Overy. The sale of shares in an IPO would invite 20% capital gains tax for the promoter or seller as the sale is outside of the stock exchange. The Supreme Court confirms the ruling of the Delhi High Court. But before we get you those stories, here's what else made news in the legal arena. The 2G bench at the Supreme Court has reserved its order on plea seeking recall of an earlier Supreme Court order restricting any other court to entertain 2G matters. Also, another order by Supreme Court stayed all proceedings in the Delhi High Court challenging the framing of charges. The 2G parties claim that restricting judicial remedy violates fundamental rights of accused. CBI, on the other hand, claimed that the parties have an opportunity to come before Supreme Court for any remedy. And also, given the case is very crucial, Supreme Court should not recall its earlier order. Compat issued notice to CCI on a plea filed by cement companies JP and Lafarge saying that the CCI's penalty of 6,300 crore rupees need to be rectified. Calculation of penalty is taking the entire group's profits into account and not the cement business alone of the companies. The Supreme Court had earlier refused to interfere with the Compat order but gave the liberty to cement companies to move Compat for rectifying the calculated penalty. The matter will now be heard on November 19. The Delhi High Court refused to grant interim relief to Colgate-Palmolive on a plea seeking stay on the Pepsodent ad. Colgate says the Pepsodent Germy Check ad launched earlier this month claims superiority over Colgate's claim. The Delhi High Court, however, not satisfied with the plea, dismissed the application, which means the ad war would continue as Pepsodent's new ad is allowed to continue. Well, after a wait of 4 years since the amendment in the Finance Bill, the draft Safe Harbour rules to ease transfer pricing compliance sees the light of the day. However, experts believe the much-touted steps may be in the right direction but have little to cheer about. Not only are there restrictions in terms of entities that can avail the benefit, the risk of double taxation looms large. Avantika Gode tells us in detail on why the new draft rules could perhaps be a damn squib. Avantika, over to you.
Well, Priyal, it does seem like this one was a half-hearted attempt by the government to ease the issues around transfer pricing. The CBDT issued draft safe harbour norms on transfer pricing, but India Inc. is not impressed because while the idea was to give companies relief and reduce transfer pricing related litigation, experts say that the number of riders that come with the safe harbour norms are certainly a big worry.
I think everyone was waiting for these norms to come out. The idea being that this would have potentially resolved a number of issues for most of the investors and most of the companies who are operating in India. Having said that, today, looking at some of the fine print, the question that really arises is that are these norms a bit too much of bit too hard for people to really comply with?
Current form that is, the way it's come out, it seems to be difficult for taxpayers to adopt this, especially given the fact that one of the years that is covered under the safe harbour norms is already a year which is gone by. This stage, I would say that it requires a lot of clarity and more simplicity in application of the safe harbour norms.
Let's take a look at some of these riders and what it means for companies. Now, the first big concern is the 100 crore rupee turnover cap. This excludes all the big players, leaving only the small to medium-sized companies to actually enjoy the benefits of Safe Harbour. Now, the draft norms have additionally brought on many issues for the IT sector. For one, there's a high operating margin ceiling on IT companies. Secondly, these ceilings vary depending on the services provided by the company. This, experts say, leaves great scope for confusion and overlap.
Today, as you are aware, I think the quantum of transfer pricing disputes in India at least is pretty significant, and at least most of the larger players today will not really get any kind of relief looking at the safe harbor norms. The fact that the kind of margins that you're looking at, the 20% and 30% margins, is again on a, especially if the idea is that for transactions which are below 100 crores, there are not that many companies, if you look at it, even in the public markets, which have that kind of operating margins. So whether the threshold itself is something which they should have, whether this kind of high threshold is something that's justified, is again becomes a big issue, and which is where really the question comes in as to how many companies will actually benefit from having the safe harbor norms.
The Rangachari committee report, which is the basis of this safe harbor norms, actually provides for safe harbors for larger companies as well. Of course, the percentages may differ. See, there could be certain reservations in the mind of the CBDT to really first whole hog make the safe harbor norms applicable to everyone. So I understand the perspective, but having said that, as I mentioned, if 100 crore is what is the limit that one is setting, then one needs to have it more simpler for companies falling in that particular activity or sector to adopt to the program, rather than again satisfy a lot of conditions and riders.
Another big concern rises in terms of India's tax treaties with other countries. Now, experts point out that the nature of these safe harbor riders could actually result in double taxation. One, because companies are not allowed to invoke mutual agreement procedures under DTAA, and secondly, because safe harbor rules are generally not considered to meet the arm's length standards.
Today, let's say for the purpose of avoiding litigation in India, which by itself can be a pretty difficult process, a lot of companies may actually end up going in and saying that let's agree to a 20% markup, or let's agree to a 30% margin. And in those sort of situations, the other country may not necessarily accept that as the arm's length standard. So especially the US, for example, may not necessarily look at the services which are provided by the Indian entity as something which needs to have a significant margin. So to that extent, they may actually then deny the potential relief to the company. And that will, for you, end up in a potential double taxation situation.
Also, the Safe Harbor draft rules state that anyone opting for this program will not also be eligible for applying under the mutual agreement procedure, which would also mean that one has to let go this alternative dispute resolution mechanism. And again, this will not help in mitigating double taxation.
Another big hit for India Inc. are the ceilings introduced on outbound intra-group loans. The critical condition here is that if the loan is below 50 crores, then the interest rate declared should be equal to or greater than the base rate of SBI plus 150 basis points. Now, for loans above 50 crore rupees, the safe harbor threshold is SBI base rate plus 300 basis points. Experts point out that the entire process of calculating domestic lending rate on foreign currency will not go down well with corporates.
In most countries, the rate is linked to, let's say, a LIBOR or some other rate. So linking it to the Indian SBI or the Indian bank rates may not necessarily result in a situation where the arm's length price actually can be met, especially if you look at the fact that in the other country, if you're trying to apply arm's length standard, the interest rate which is probably paid out by that company to the Indian company would probably be on the lower end of the scale. For example, if I have a US subsidiary and if I lend to the US subsidiary, a US company could probably borrow today at a 5% rate or a 6% rate, whereas here I'm potentially looking at the arm's length standard to be a 12% rate. So that will definitely be that will definitely cause a lot of concern.
While nobody can rule out the limited relief that these norms will bring, it's evident that the litigation and uncertainty around transfer pricing are far from over.
Well, Avantika, thanks for that. But of course, we'll have to see how the real final guidelines or the rules really take shape. But we do understand that there will be little dilution in terms of what has already been put across in the draft rules. So let's wait and watch what the final rules are. But time now to head into a short break. On the other side, the recent RBI direction on forex curbs has got the deal makers worried. Sanjeev Thuna of Allen & Overy says India loses the level playing field. More on the other side.